Real quick, what is private equity? We had a big spot in the limelight during the 2012 presidential election, for better or for worse. A lot of demonizing going on, but we're generally pretty good guys. We are asset managers first and foremost. Our primary investors are pensions and endowments and charities. These are your Rice universities of the world, hospital systems, public teachers, pensions funds, people like that. Through them, we're a source of capital. We like to think of ourselves as patient and experienced and disciplined investors, an alternative to the public capital markets, which tend to be very short-term focused, we think, sometimes at the expense of long-term profitability. We're also strategic partners. We're very focused on relationships, who we're doing business with, the entrepreneurs that we're partnered with, and we think of ourselves as true partners. We bring to bear what we can. In Lime Rock's case specifically, it's our energy finance expertise. It's our connections to the capital and the M&A and the talent markets, and our prior lessons that we've learned from companies that we've invested in the past. The whole point of this slide is precisely that you can't read it from the back of the room. These are all of our competitors in the energy space. We may have missed a few, but that's okay. The industry is very large. The energy industry is very large, and it's incredibly capital intensive, and there's lots of places to put money to work. And I'll make the point in a little bit that we're in an incredibly exciting time in the business. It's great for Houston. It's great for Texas. It's great for the U.S. And there's a lot of exciting things going on. Quickly, the Lime Rock Commercial. We have about $5 billion of total capital under management. We have two different fund strategies: Lime Rock Partners and Lime Rock Resources. Partners has about $4 billion under management. Resources about $1 billion. Lime Rock Partners was founded in 1998 in Westport, Connecticut. We now have about five offices worldwide. It's very much a global strategy. We focus exclusively on energy, mostly on upstream oil and gas, and specifically exploration and production and oilfield service. Our companies, we're providing growth capital to them primarily. If you think about the continuum of equity investing, you've got venture capital, you have growth capital, and then you have kind of buyout capital where you're investing in mature businesses. And we mostly play in the middle. Sometimes we step down to late stage venture. Sometimes we participate in investing in larger companies. Lime Rock Resources is also a fund. It operates as basically a standalone exploration and production company. Their focus is on production. It's a yield-oriented strategy. They focus on acquiring low-risk, mature assets and returning capital to their investors through free cash flow distributions. So this is stating the obvious, but it is an incredibly scary time to be putting money to work in the world. World economies are incredibly fragile. There's a global deleveraging cycle that's going on everywhere, which is going to be a drag on growth. Europe is a complete mess with no resolution in sight. China is a complete black box and maybe heading for a hard landing. The U.S. recovery is nascent, slow, and completely hooked on fiscal stimulus. Politicians around the world are not coming up with any real answers, which is hurting confidence in the private sector. Despite all this, you're seeing the U.S. stock market hitting all-time highs, debt yields are incredibly low, and you've got people stepping further and further out on the risk curve looking for yield in a zero interest rate environment. Some of this is monetary stimulus, people looking for places to put money when they know that their idle cash is a guaranteed negative return. And I think some of it is we're the best looking house on a really bad block. So a lot of this is people also saying, man, I've got to play. Market's going up. I need to participate. I just, hope I'm good enough to pull my money off the table when the music stops, and I, hope I have a chair. The problem with that is that timing the markets is incredibly difficult. We feel it's not a time for big, bold market calling bets. Diversification is important. Proceeding with caution is important. Within energy specifically, we're looking at spacing investments over time, over geography, multiple commodities. And in general, it's really a back to basics, teams over themes is something that we tell people. It's bottoms up, let's go find the best company and the best teams with unique strategies to go do business with, and whether the market's rising or falling, those guys can usually, and gals can usually make good money. So despite all that, there is a really big theme that's going on right now, and that's what we call the renaissance in U.S. oil and gas. Dave touched on this previously. The production response that we've seen in both oil and gas in the U.S. is just incredible. On oil, we've essentially reversed a 40-year decline in crude production. We're up 2 million barrels a day in the last few years. Gas is very much the same story. We're up 18 BCF a day since 2005, which is just a staggering amount when you think about how tough people had just keeping production flat for so long. The basic technologies that made this possible are well known and well understood. It's primarily hydraulic fracturing and horizontal drilling, but they are definitely not new. This is a chart going back to 91 of the horizontal rig count. It was a 10% market share then. Horizontal rigs now are 60% market share, and that doesn't take into account the deviated wells that get you to 80. One thing we like to give is a quick pop quiz. If anybody knows who the NFL champion was when the first hydraulic fracturing operation occurred, you can shout it out. It was the Chicago Cardinals, and in 1947, when Halliburton did the first frac job. Since then, there's been 1.1 million unique fracturing jobs, mostly in the United States. So what's new? And the answer is a lot. First and foremost, we're doing much bigger jobs now, frac jobs. You're doing simultaneous hydraulic fracturing, zipper fracs, real-time microseismic, nanoscale reservoir analysis, advanced fracturing fluids, automated AC drilling rigs, pad drilling. The list goes on and on. A lot of these changes I would characterize as evolutionary rather than revolutionary, but they all add up to having a really big impact. And it means we have a better understanding of the reservoir. We're learning how to develop these bad rocks cheaper and more efficiently. And what it's leading to is really a manufacturing mindset in the business, and basically a new era of resource abundance, which is completely disrupting the business and making people change how they have to think about it. So we could talk a long time about this, but 4 reasons the supply renaissance has changed the game. For U.S. natural gas, the cost curve has been completely upended. I borrowed a couple graphs from Dave and his colleagues at Tudor Pickering. The graph on the left is from 2007. Notably, it's basically saying what the average basin economics are in all the major plays that were going on at the time. And at the top, you see plays like the Pinedale and the Barnett, which were pretty big news. Tight gas was coming into its own. But LNG was a big part of the equation then, and everybody talked about it. And the real question was, how do all of our conventional gas basins compete against LNG, which has a $4 to $6 per MCF break-even price? You fast forward to today, you look at the graph on the right, the Pinedale and the Barnett are on the bubble of what's economic at today's gas prices. And the real question now is, when will we need more supply than what can be produced in the Marcellus for $3 to $3.50 an MCF profitably across a really large play? There's 200 TCF of discovered resource there, and there's probably another 100 in the Utica and the Devonian shales and everything else that's around there. And that's not even taking into account new gas that's coming online from all the other plays around the country that are being developed primarily for their liquids. Again, Dave's favorite term. This is real quick. I call these the big 3 gas giants. The Fayetteville should probably be on here too. The Barnett's in the red, Marcellus in the blue, and the Haynesville in the green. And what you're seeing here is really 2 things. These 3 fields account for 19 BCF a day of total production today in the U.S. That's a quarter of all of our production, and they all really came into their own within the last 8 years. If you start with the Barnett, and you look at the Haynesville and the Marcellus, those got going in 2008 and 2009 after the crash happened. The other thing that you see here is that the rig count is down quite a bit from their peak in all 3 of these plays, yet production is either flat in the Haynesville and the Barnett's case, or still rising in the Marcellus's case. What that means is that These plays are prolific, they're huge, and people are figuring out how to do how to do more with less in the industry, and we're getting even better at what we do. The other amazing thing is that we're just getting started. We're in the early innings of all the Appalachian Gas Plays. We've got old plays that are kind of getting new legs from all this new technology that's being applied to them around the country. Quick example, the Barnett on the right, it's 5 million acres in size. There's 12,000 wells producing 5 BCF a day. The Marcellus, by comparison, is 19 million acres. It is producing 7 BCF a day from 3,000 wells. If you, I can't reach the laser pointer here, but if you look in the southwestern corner of Susquehanna County, it's basically the red dots on the northeastern corner of the map. There's almost 2 BCF a day coming out of just that county alone. And that's definitely a core. It's the best of the best, but that whole play is economic at $4.50, certainly at $5. And what that means is that we just have a tremendous amount of supply that works at those prices. So it's very tough for me to sit here and go long on conventional gas strategies that require $6-7 an MCF to be profitable. Point number 2 is the peak oil can has been kicked very far down the road. The U.S. This doesn't mean that the U.S. is the world's new swing producer. We've accounted for almost all of the non-OPEC production growth, but it does mean that we're becoming more self-reliant, and it also means that these technologies and techniques that we're perfecting here are going to be exported eventually, and they are right now. And it's the tight oil box that you see in the supply side of the equation here is filling a really big gap that existed for a while and was leading to all the the calls for peak oil and everything. And this has turned into a big solution for the world. It's good for everybody, and it's bigger than whether France is going to allow fracking or Argentina is going to stop stealing people's money. It's China marshaling its industrial might to develop all the resources they have there. It's Russia and Saudi Arabia saying, I've got incredible conventional production. I also have some incredible source rocks that sourced all that production that has way more oil in them than I've ever produced or I'm going to produce out of these other rocks. There's a tremendous amount of supply that's been opened up to the world. This is just a graph from Credit Suisse, I think, that shows where all the growth's coming from over the next 5-6 years. The bar on the far left of this graph is U.S. onshore. It's plus 4 million barrels a day. The next guys after that are Canada, Brazil, and Iraq. I can tell you from having a portfolio company in Iraq that if that country could get its act together, it could be 2 or 3 times what that is on there. So there is a lot of supply out there. Peak oil is less of a concern. The stuff in the U.S. is certainly price sensitive, but we'll get to that in just a second. Point number 3 is energy independence. It's a political buzzword. Both sides of the aisle are claiming credit for it. Everybody wants it. It's great for everybody, right? I like to call it energy less dependence because we still need Canada and Mexico to get there. But it's definitely happening. I think we're already there on gas. We could probably turn all the pipes off that are coming into us from Canada and be completely fine. On the oil side, the chart on the right, from 2007 to 2012, you've seen our net imports of liquids go from, I think that's crude, no, it includes NGLs and biofuels. It's gone down from 12 to a little under 8 million barrels a day now. So we've definitely seen progress there. This is just a graph showing the projections, again from Credit Suisse. You're seeing the red line's where we are today. We're definitely on an uptick, and this is a pretty consensus view on Wall Street that North America will be independent and self-sufficient when it comes to liquids production by 2022. Point number 4, Dave made it earlier, there's major implications for the U.S. economy. From all this that's going on, there's almost 500,000 direct jobs in oil and gas and supporting industries today. Analysts predict that could double, triple from here. There's a tremendous amount of capital investment that needs to occur. We're talking hundreds of billions of dollars just in well construction and the services associated with it, let alone pipeline construction, refineries, roads, everything else. On the indirect side, these impacts are far-reaching. It's going to make our entire U.S. manufacturing base more competitive in the world. Everything that uses oil and gas as direct feedstock directly benefits. It's going to lower material costs for everybody else, and there's no telling how many more jobs this creates. It's definitely in the millions. It's also going to help our trade imbalance. It has foreign policy implications. The U.S. is always going to be interested in maintaining world order, but the calculus on the Strait of Hormuz becomes a little simpler when we're not depending on barrels coming out of there. So the big questions are, will prices be high enough to continue to make this volume growth possible? On gas, it's definitely a question of demand. We just peaked above 70 BCF a day last year. We think this is happening. There are a ton of undercurrents in the market right now. You've got the early retirement of coal plants. You've got people putting in chemical plants, fertilizer projects, talking about converting the transportation fleet to natural gas. The market is responding to this, and we think that this will be a big theme for people. On the oil side, it's demand and it's supply. I said that the supply that comes on is very much price sensitive. The U.S. has kind of been having our cake and eating it too, supplying pretty much all the incremental demand. We're supplying oil that's going into pretty much all the incremental demand, net demand in the world today over the last year or two. That's been made possible by Iran barrels coming off the market, Saudi holding back, supply being constrained in areas where people thought it was previously going to be a lot higher. And it has some very interesting implications that Dave mentioned earlier, just around U.S. crude prices perhaps decoupling from the world, and you having all these little micro basins where you've got to think about a lot more things than you used to. You can't just assume that you're going to get WTI pricing on your crude anymore. So what does all this mean for investing in the energy business? Our number one focus always is people. It's the team, the track record, their ability to execute, who we're in business with. Within E&P specifically, in an era of resource abundance, you have to focus on producing the lowest cost molecules, period. That's it. That's all that there is now. People are shifting from an era of the land grab to being focused on capital discipline. Profitability is very important. Everyone is a strong word, but most of the industry is very land rich now, especially the bigger guys, which means that there's not as many acquirers of the companies that we typically back, which means that we need to be prepared to stay in the game longer. That means having the teams that can actually execute full cycle, and it also means having the capital to stick with it long term. In oilfield service, North American equipment is overbuilt by and large right now, which means that there's not as many places for us to put growth capital. So it's a quieter time for us there, but we're keeping our eye on some pretty good companies that we'd like to be in business with eventually. North American margins feel like they're stabilizing. You're starting to hear some of that from some of the public companies that are doing their quarterly calls. International margins have been increasing steadily for a while now, and we're definitely investing into that. Infrastructure, as has been pointed out, is going to be huge. There's going to be a ton of people that make a lot of money here. We're talking hundreds of billions of dollars that need to be invested over the next couple of decades just for pipelines and compression and everything else that goes into making these plays possible. Technology side, completion technologies are very big. These plays have huge resource in place, and we have incredibly low recovery rates by and large, especially in the oil plays. Just moving your recovery percentages a percent or two has huge implications for profitability. So that's really a big prize for people. It's about we're using a brute force method of just putting down as much water and sand as possible. And it's, people are trying to get smarter about it. They're trying to spend less money when they do that and do things more efficiently. And eventually you'll also export the resource revolution abroad. As I said, there's bad rock all over the world that has a lot of resource in it. The U.S. has some very unique things going for it that have made this possible. But first and foremost, it's private mineral ownership. You've got people who are aligned with getting the oil and gas out of the ground, but it's also, there's a big service sector already in place, and there's just much better support here. It's a stable legal system, everything else. There's a trail of tears from all of the international shale plays that we've looked at over the last few years and just are a long way off. But Bottom line, it's an incredibly interesting time to be investing in energy. There's definitely an undercurrent of uncertainty in the world, but we're very happy to be where we're at and what we're doing. And if anybody is looking for capital, come talk to us.